Welcome back to Forex Gurukul. Before you place one more trade, I want you to see something that quietly takes money out of your account every single time you click buy or sell, and almost nobody looks closely enough to notice it. Meet Danny. He buys euro-dollar, and the second his order fills, before the chart has printed a single new candle, his position is already showing a loss. He calls his broker, sure something's broken. Nothing broke. Something happened the instant he clicked buy that has nothing to do with where price goes next. And it's sitting in two numbers on his screen he never really looked at, called the bid and the ask. Until you understand those two numbers, every trade you open starts you in a small hole before the market has said one word. Let's go find those numbers on Danny's screen. Two words, two prices. The bid is what the dealer is willing to pay to buy from you, so it's what you receive if you're selling. The ask is what the dealer charges to sell to you, so it's what you pay if you're buying. Here's the part people miss. Those terms are written from the dealer's seat, not yours. When your platform shows a bid, that's the dealer's buying price, not your selling wish. But platforms rarely write bid and ask that plainly. They use two friendlier words instead. And those two words flip the whole picture around in a way that trips people up constantly. This is the trap. Your platform doesn't say bid and ask on the buttons. It says buy and sell, for clarity. Click buy, you get quoted the ask, the higher number, because you're buying from the dealer. Click sell, you get quoted the bid, the lower number, because you're selling to the dealer. Same definitions from a moment ago, just relabeled for you. But that still leaves the real question sitting there. Why are there two different numbers at all, instead of just one honest price? That gap has a name, and that name is the whole reason Danny's trade opened red. The gap between the ask and the bid is called the spread, and it is the dealer's built-in profit margin. Go back to Danny. He buys at the ask, the higher price. If he flipped around and sold immediately, he'd only receive the lower bid. That difference disappears the moment he opens the trade, before price has moved a single pip. That's the answer to the mystery we opened with. But it raises something bigger. Who exactly is on the other side of Danny's trade, taking that spread? Is it another trader or someone else entirely? Quick pause, guess before I say it. When Danny clicks buy, is he matched against another retail trader who happened to click sell, or is he simply transacting against a price the dealer put up? In retail Forex, you're almost always a price taker. You're not matched peer-to-peer, you're trading directly against the dealer's quoted bid and ask. That single fact changes how you should think about who's actually profiting on the other side of your fill. And the part that actually explains why your broker is fine either way, win or lose, is coming right up next. Most retail Forex brokers aren't really acting as a broker in the classic sense, matching your order with a buyer or seller for a commission. They function as a dealer, quoting you their own bid and ask, and profiting from that spread. A 2-pip spread on a standard lot round trip runs about $20, gone the moment you enter and exit, regardless of whether the trade wins or loses. That's not a fee tied to your success. It's a toll on the door, paid every time you walk through it. First, on this idea over the shape of any single setup, context matters more than the trade itself. The same spread costs you far more relative to your target on a tight scalp than on a swing you're holding for days, so know your holding time before you worry about pips. Now the terms. Selling at the bid is called hitting the bid. Buying at the ask is called lifting the offer. Both cost you the spread. Say Danny buys on a confirmed breakout candle that closes above resistance. That's his entry trigger. He's lifting the offer. His stop sits below the recent swing low with a little wiggle room for noise. His target is sized off a 2-to-1 reward to risk. Here's the honest part. This setup can still fail. The pattern doesn't save him, the stop does. That's the thing this whole video was building toward. Amateurs count pips. Professionals count risk. Quick recap. The bid is what the dealer pays you. The ask is what the dealer charges you. The spread, the gap between them, is the dealer's built-in profit, and it's the one line here worth circling because it never disappears, win or lose. You're a price taker against that quote, not matched against another trader. And your broker is functioning as a dealer, earning from that spread rather than a commission. That's exactly why Danny's trade opened red the moment he clicked buy. Nothing mysterious, just the ask he paid versus the bid he'd have received. Next time, we take this spread and turn it into an actual number on your charts, pips, and why traders who don't understand pip value blow up their accounts on position size alone. Tell me in the comments which pair you're going to go check the live spread on right now.